Welcome. My name is Andrew Metrick. I am a finance professor at the Yale School of Management and the director of the Yale Program on Financial Stability. And today I am delighted to have my friend Viral Acharya here today to talk about his new book, The Quest for Restoring Financial Stability in India, which is a collection, an important collection of the work that he did and the speeches that he gave while he was deputy governor of the Reserve Bank of India from 2017 to 2019. I would imagine that most people who are on this webinar know Viral from his time at the RBI, but long before he went to the RBI, he was a superstar in my field of academic finance, where he is the C.V. Starr Professor of Finance at NYU Stern and one of the most productive scholars in the area of financial stability, which is the area that he has been working on for far longer than I have, and I've been reading his papers for many years. We're always amazed, actually, in our profession at people who can continue to write so many good papers every year when many of us struggle to just get out one, and now he's one-upped us. He has a book. And just today, I saw he has a new paper with Raghu Rajan. So I'm really looking forward to hearing from Viral today. What I encourage everybody to do is to, if you have any questions, please type them into the. It's either we have a chat or we have an alternative way to do it. Alex will send me a chat and let me know. But I think we can have everybody putting into the Zoom webinar chat and giving us some questions. Q&A, I apologize. I'm getting confused from my days of teaching when they can put it into the chat. So please type your questions into the Q&A. I will be looking for those. We're going to hear Viral talk for about 30 minutes or something like that first, and then I have some questions and you'll have some questions, and we will go until 10:30. One thing I was delighted by and learned from in this book, Viral, I have to say, is we are always told here at American business schools that we should not use analogies about American baseball or American football. You know, our students will not get them. And I think, oh, come on, everybody knows those sports. And then, of course, you have so many cricket analogies in your book, and I still don't know you. The rules of cricket have been explained to me many times, but they're very confusing to me. So I enjoyed, that was a lesson for me. I learned a lesson. I don't get those analogies. So I'm going to be more sensitive myself about using them in the future. But it's a wonderful book and very important and very timely. So without further ado, let me turn it over to Viral Acharya.
That's great. Thank you so much, Andrew, for that lovely introduction. And thank you also to Ashley and Alexandra for helping out with organizing this talk. Good morning to all the audience, or good afternoon, evening, if you are joining from elsewhere. You know, as Andrew said, I wanted to give an overview of what I learned during my term as a deputy governor at the Reserve Bank of India. And to do that, I wrote a preface chapter in this book titled Quest for Restoring Financial Stability in India. Some people have sort of wittingly written reviews about the book saying it's an eternal quest, and it indeed is. My sense is it's an eternal quest, not just in India, but probably in other parts of the world as well. And therefore it needs sort of tireless gatekeepers and soldiers, as I saw myself on the field when I was doing this job. But I want to say something which helps put a perspective on how one should think about financial stability in India at the present moment. And it likely offers a perspective also on how to think about financial stability and some considerations that arise in other parts of the world, including developed countries, as we stand right now in the midst of COVID. And my key point is going to be that the fiscal and the financial stability issues are getting increasingly intertwined in most countries. And the central bank is getting caught up in between this joint between the fiscal and the financial stability, and how much the fiscal permeates into the financial stability starts depending crucially on the operational autonomy or the independence of the central bank in its decision making. So my speeches, which are summarized in this book, they were really a tool for change. They followed a certain pattern. They tried to bring international evidence to the table to provide a framework to explain what has worked, what has not worked. And then they contextualized to India and then, of course, pushed for a particular reform. There's speeches on all kinds of topics, starting from resolution of bad loans to monetary policy transmission, to creating a public credit registry, and then, of course, to development of capital markets, and maybe the last section, which is on the overreach of the government balances into affecting the independence of the central bank and crowding out the private sector, perhaps get at the core of what I'm going to soon talk about. So let me give an overview by in fact, a little bit of a recitation from the preface chapter. So I left New York for Mumbai on the evening of 21st January 2017. And as I sat at Newark Airport, awaiting to board a United Airlines flight, I couldn't help reflect on the fact that the Indian banking sector at that point was sitting on one of the highest non-performing loans to assets ratio among the G20 countries. In fact, this ratio was and is even among the highest in the group of emerging markets, if you thought that was more of an apples to apples comparison. And importantly, this was a marked departure since India's standing in 2009. Now, the poor capitalization of Indian banks from an economic standpoint had already been reflected in the stock market data. The Indian banks, especially the public sector banks, had extremely low market to book ratios, indicating that their books hadn't been marked to their economic value. And we were, of course, seeing this stress quite evidently in the New York University Stern School of Business systemic risk rankings that we started, calculating and posting on our website every day since the global financial crisis. So anyone who was objectively looking at the Indian financial sector standing in January 2017 knew that the banking sector and economic growth in India were at risk. Now, what's important is that the banking sector in India doesn't experience stress like the global financial crisis. Stress in India plays out somewhat silently, just as in China, where state-owned banks hold the majority of deposits and loans. And this is because of the important difference in the ownership structure of banks in India and China compared to most of the world elsewhere. Government ownership of banks means that depositors do not typically run en masse on public sector banks, even if bank borrowers are defaulting en masse on the banks. Now, this support or implicit safety of these public sector banks is seen by some as a positive backdrop for financial stability. Now, even that backdrop is not positive if the sovereign balance sheet itself becomes constrained or is considered to be on the brink. Nevertheless, even if the sovereign is not on the brink, undercapitalization of public sector banks, combined with the fact that there is not much market discipline on their lending, and possibly there is interference in their lending decisions for political objectives, it leads in these countries to a serious misallocation of credit. And one form that this misallocation of credit takes is what is called as evergreening or zombie lending. So there are borrowers who have already defaulted or most likely would have defaulted on bank loans. And because banks do not want to recognize the losses, because that would require the governments to recapitalize them, banks simply extend and pretend the loans of severely distressed borrowers as though everything is okay. And it looks as though bank capital is just fine. But of course, the market knows the true quality of the loan book, and the market to book ratios are actually suffering very heavily. Typically, this evergreening phenomenon is supported by explicit or implicit regulatory forbearance, which is that the banking regulator has turned a blind eye to the fact that it's happening, or in fact formally blessed it in the first place. Now, these undercapitalized banks, because they are so focused on lending to these zombie borrowers, they typically don't lend to healthier parts of the economy at reasonable costs, even if these banks are never witnessing bank runs. So, this form of a silent crisis, and I stress this, that just because the banks are not experiencing panics, one should not assume everything is okay in India or in these banking sectors. And in fact, the silent crisis had been playing out in the Indian banking sector since 2012-13. And this was because of the boom and bust of the credit-driven fiscal stimulus in sectors such as power, infrastructure, steel, and so on, in order to address the growth slowdown that hit India post the global financial crisis of 2008. So when I was boarding the flight, I asked myself a question: could a push be made to address this unfortunate state of affairs in some decisive manner? And I got energized by the thought, and I said, maybe when I reach the Reserve Bank of India, if there's a meeting of minds with the top management, I could hit the ground running, since this had been my expertise in my research for a long time, including some advisory roles at central banks and so on. So, I sat down to make a checklist manifesto. It was titled Restoring Financial Stability in India. Hence, my book is called Quest for Restoring Financial Stability in India. And it was a pretty short list. It just had 2 points. First, fix the health of the banking sector, especially that of public sector banks, with reforms such as consideration for a change of ownership away from government ownership, a recapitalization, a prompt corrective action for undercapitalized banks which had repeated track record of poor underwriting standards, a timely recognition of losses, and a decisive resolution of stressed assets to get the firms in the real economy back up and running rather than being zombies. And the second bullet point was to develop financial markets to improve the efficiency of capital allocation, importantly, to reduce the dependence of the system on bank credit, and allowing for market-based mechanisms to reward and punish the borrowers and the financial sector for their outcomes. Now, maybe it's a bit too early to assess, but let me provide my assessment of how this quest at the central bank worked out. And let me focus primarily on the first issue, though I will touch upon the second issue of the markets very briefly as well. We achieved moderate success in terms of fixing the health of the banking sector. In fact, within a year since I had joined, considerable progress had been made in restoring financial stability in India. The asset quality review to recognize the bad loans properly had been initiated in 2014-15. It had reached its conclusion, and bank balance sheets were more accurately marked. The government of India had announced by then a significant recapitalization package. So this is within a year of my joining. And for the first time, the recapitalization money was to reward healthier banks so that they could grow. And the weaker public sector banks were to be put under the Reserve Bank of India's prompt corrective action framework, which was tightened to get closer to the framework in the United States. And most significantly, the resolution of large non-performing zombie bank assets was put on a fast track on the back of the Insolvency and Bankruptcy Code, which had just been enacted in 2016. The idea was to get time-bound, swift resolution of these cases. Everything was on track. It seemed that markets, rating agencies, multilateral institutions, they were recognizing these important steps in structurally reforming financial stability agenda for India as being very positive for its long-term growth and sovereign credit rating. But things didn't turn out that way all the way in the end. In just about 10 months that followed, not only did progress stall on these issues, but in fact, several policies regressed. Capital was injected in weaker rather than healthier public sector banks. Not much market capital was raised by any of the banks as originally envisaged. Capital standards and prompt corrective action framework were diluted. Forbearance in recognition of losses crept in again for some asset classes, such as the small, micro, small, and medium-sized enterprises or MSMEs. And in fact, the resolution of the several large non-performing zombie borrowers under the Insolvency and Bankruptcy Code was stayed by the judiciary. In parallel, the central bank came under intense pressure to open up liquidity and credit taps, both to support the government bond markets as well as to prop up the economy. And of course, these were pressures that were resisted and reasoned against. In the end, some compromises were reluctantly struck, but I think the first year of the positive progress had such high levels of ambition and institutional anchoring that a complete meltdown was prevented because we had started off at a very good point. In fact, as I mentioned, the source of the bad loans was the excessive monetary and credit stimulus post the global financial crisis. And it was imperative that we do not allow a complete degeneration into that sort of an excess just within a decade of having seen it, and before we had actually cleaned up the mess that resulted from that boom and bust cycle. So all of this, when I reflected upon, both during my term as well as afterwards, several questions kept coming to my mind, and they kept me up at nights often. And some of these were, why are efforts at restoring financial stability seen as contradictory to pursuing growth, even though by now all evidence points to financial stability being a necessary condition for long-term growth? Why is it that the central bank, such as the RBI, when it seeks to implement financial stability reforms fully and sustainably, always faces an uphill battle with the entire system, including the government? Is there a common undercurrent of resistance which makes it hard to achieve consensus on long-term structural reforms to the financial sector, even if they make much economic sense? And finally, does the pursuit of growth in India focus mostly on credit-based stimulus in the short run? And is this what causes efforts to restore financial stability to routinely stall? And it became clear to me gradually towards the end of my term, and perhaps even more clearly once I returned to NYU, that I could come up with nice stories and specific chain of events for answering each of these questions in a particular example setting, but that there was actually a deep undercurrent and a uniform answer to all of these questions. And I'll refer to this as fiscal dominance. And I'm going to exaggerate and position it. I think I'm only exaggerating slightly, but I'm going to position it as a theory of almost everything in India. So what is fiscal dominance? Fiscal dominance is traditionally defined in macroeconomics as a state of the country in which the government is accumulating large debts and deficits, so is spending far in excess of its revenues. And the rollover of its debt and financing of its deficits becomes so important in its overall functioning, that it starts preventing the monetary policy authority, such as a central bank, from meeting its mandated economic targets of inflation, growth, and employment. In fact, just in the last 6 months, I've heard the fiscal dominance term in advanced economies more than I had heard in the last 10 years. And that's because even in advanced economies, the government deficits have risen post-COVID very sharply in a short period of time. The debt to GDP ratios of advanced economies have risen very sharply since the global financial crisis. And everyone is now beginning to attach significant probability to a fiscal dominance scenario in which the central banks may get distracted from their inflation targeting mandates and instead be forced to choose interest rate and liquidity policies that are primarily focused on helping the governments roll over their debts. What are the costs of this sort of fiscal dominance? One, coming back to the cricket analogy that Andrew mentioned, I'll just explain it. In cricket, there's two formats. There are many formats, but the two extreme ones are that there's one format in which the match gets played for about 3 hours, like say a baseball match. It's called a T20 because there are 20 sets of 6 pitches from each side. That's why it's called a T20. And then there's a old traditional format, which is called as a test match, which gets played over 5 days. And my analogy is that the governments, by and large, are playing T20 test matches, especially when they get close to election cycles. In India, of course, elections happen all the time because there's national elections and state level elections. And as these elections approach, the governments get focused on designing short-term populist programs that can be marketed as being delivered by the parties. Of course, the ruling party seeks to posture the growth during its term as having been very rosy. A quick reflection of growth, a tangible reflection of short-term growth in hands of people is if they are getting easy credit from banks. And the financing of certain government programs requires that they take on additional debts in order to fund these programs if they are just distribution of subsidies or welfare packages to the citizens. Now, the central bank, in contrast, has objectives such as guarding the depositor interests of banks, maintaining price stability or keeping inflation at reasonable levels. And in case of quote unquote small open economies such as India, also safeguarding the external sector to ensure that there isn't a sudden stop and foreign investors don't pull out funds because of a depreciation spiral. Now, all of these objectives are what I call as playing a test match. You can play these objectives only over the long term. Sometimes to protect depositor interests, you can't allow banks to lend too much and poorly just for short-term gains. You can't allow risking of inflationary pressures because you want to generate short-run growth in lead up to an election. And you can't take on short-term foreign currency denominated debt for the government because that could risk a downward spiral. Maybe it'll happen after the election, but that could be very costly for the long-run growth of the economy. Now, when a central bank gets fiscally dominated, it starts forgetting, or it's being forced to forget, the primacy of its long-term objectives, and instead has to focus primarily on the government's short-run or the T20 objectives of making growth look good, giving credit in the hands of the citizens, and allowing it to finance its short-run populist programs. Now, clearly, as I said, first and foremost, this has costs to long-run stability of growth and the other macroeconomic parameters. But second, and something that I pushed very strongly in one of my most sort of noticed lectures at the central bank, it was the A.D. Shroff Memorial Lecture, wherein I positioned central bank's independence as being of as great an importance as, of the judiciary or the election commission of a country. Because I see that a central bank in a democracy serves a checks and balances function because it has to remain independent and throw sand in the wheels of excessive borrowing and spending programs of the government that may compromise the banking system, especially in a country such as India, where the distance between the government and the public sector banks is really that, that they are government owned, and so the distance hardly exists. Now, what is the main point I want to convey here? The main point I want to convey is that this traditional macroeconomic notion of fiscal dominance, notably due to Neil Wallace and Thomas Sargent, is one in which the focus is primarily on monetary policy, as is the discussion right now in the advanced economies. However, for an all-purpose central bank such as the Reserve Bank of India, and given the overarching presence of the public sector institutions in the Indian financial sector, fiscal dominance takes a far more pervasive role in India. It extends not just to liquidity and the rate setting policy of the central bank, but importantly, it carries over also to the bank regulation, bank supervision, and most crucially, even the disclosure of whether defaults have taken place on bank loans or not. Now, let me just explain a little bit of how this works. I want to give you one fairly well-known example and one somewhat convoluted and unexpected example of how deep and pernicious the effects of fiscal dominance can be on these non-monetary functions of the central bank. So let me first talk about bank recapitalization and regulation. Now, since the timely recognition of losses leads to an additional capital requirement for public sector banks, and because this is typically met out of the government budget, the central bank finds itself pulled into regular negotiations with the government regarding regulatory forbearance. Such forbearance takes the form of relaxed standards for loan loss recognition. Most provisioning in India, in fact, starts after the losses have realized, so it's entirely backloaded and really slow. And India has resisted switching to modern accounting standards that recognize losses in anticipation based on expected default losses rather than once losses have materialized. All of this is because these moves get blocked in one way or the other by the government. In the case of some asset classes recently, such as loans to micro, small, and medium-sized enterprises, there's been a forbearance once every year. In fact, sometimes more than once a year. So it's very clear that the malaise of this sector in India is no longer cyclical. It's most likely structural because it hasn't been fixed even after 5 or 6 years of such forbearance packages. Now, as a result of this repeating regulatory forbearance that becomes near permanent, as I just explained, most public sector banks in India always remain short of true economic capital adequacy. Their books are just being managed on a regulatory capital front to look about right, but their market capitalization is very poor and their outlook is generally credit negative as far as rating agencies are concerned. And as I explained earlier, what do these undercapitalized banks do? They either do zombie lending, so they evergreen the borrowers, giving them even more loans in order to avoid recognizing losses, or they do lazy lending to the government. They just keep buying government bonds because you can buy government bonds without adding to your regulatory capital requirements. And this is one of the reasons why the pressure on the government to recapitalize these banks is not that high. Now, as the central bank relaxes these capital standards, say for micro, small, and medium-sized enterprises or for the large borrowers, it ends up relaxing these standards not just for public sector banks, but also for other players such as the 1/3 of the financial sector, which is now entirely private. Overall, this is a rather unfortunate compromise of accounting integrity and capital adequacy of India's banking balance sheet. It's just a form of window dressing, which just keeps going on year after year. And then when a shock such as COVID hits, it takes an altogether new dimension And then the financial sector is never able to do anything other than figure out how to deal with its legacy losses because they've never really been provided for. Second, let me now come to what I found a particularly intriguing example of fiscal dominance of India in India. When I joined, I wanted to start looking at who were the large defaulted borrowers. And I started asking around in the supervision department. I was told, since I'm not a deputy governor in charge of the supervisory department, I can't get this data even if I'm within the RBI. I said, okay, these are large firms. If they've defaulted, this must be in their quarterly filings. And my research team started putting this data together. And lo and behold, we knew all these firms had defaulted, and yet they had never ever explicitly disclosed anywhere in their quarterly filings that they have not been making payments to their bank loans. So I was quite stunned about this. And then I figured that what has happened is the following. In most parts of the world, stock exchanges and securities regulations that govern the listed firms, they require that materially relevant information must be disclosed by a firm with immediacy to investors who purchase stocks or bonds. Now, you can see why this is important. It is important for efficient allocation of capital. It's important for correct pricing of capital. It's important to prevent the minority investors from being front-run by those who have access to private information about the firm having some liquidity problems, etc. And in spite of a clear recommendation in India by an independent committee and earnest efforts of the securities market regulator, India avoided providing timely default information to markets. And the rationale is that if defaults were disclosed, then rating agencies would downgrade these firms, banks would have to start providing higher capital requirements. And if that happened, then the government would have to actually create space in its expenditures, cut back, engage in some austerity because it would have to recapitalize the public sector banks to a higher extent. Now, of course, the government doesn't want to do this. And so what does it do? It goes and requires that the securities market regulator not require such disclosure of defaults, even in case of publicly listed firms and bonds. Now, at one level, these interventions, I refer to them as fiscal dominance because they are essentially coming from this desire to keep rolling over the government balances and the fiscal programs. But what is important is that fiscal dominance in India, which was very high in 1970s and 1980s. So Dr. Y.V. Reddy, former governor of the RBI, who has written a masterful foreword in the book that I recommend very, very highly. It gives a historical backdrop of fiscal dominance and financial stability in India. He essentially says that in 70s and 80s, these sorts of arrangements didn't matter. Banks had just been nationalized at that point. So there were no private sector banks in India to speak of. And the fact that the government, the central bank, and the public sector banks were all working together to support government's borrowing programs and expenditures was basically like a cozy Hindu undivided family in which no one kept anyone else's accounts. It was all public sector banks, so there were no concerns if there were any bad loans, etc. And anyway, most of the lending was to the government because India was a nationalized economy at that point. Now, since the 1990s reforms, this is no longer the case. India has liberalized. It has a meaningful private sector in the real economy. It has a meaningful private sector within the set of financial firms. And therefore, it's no longer aspiring to grow just at the 70s and 80s growth rate of 3.5%, given its demographics and the available opportunities to unlock. It's looking to grow at rates of 8.5%, 9%. And this double-digit growth aspiration, unmaterialized, has always been there. So for a while after the 90s reforms, India's growth was very strong. The government balance sheets were actually consolidating. The expenditures were coming down because the private sector was allowed to flourish after the 1990s reforms. And this was also a time when, because the economy was flourishing, the households were experiencing significant growth in the real wages, and they were actually saving a lot more on their balance sheets. So it became easier to fund the government because the domestic savings were actually on the rise. Now, post-global financial crisis, the global headwinds to growth have increased. Many advanced economies have still not fully recovered on their growth potential. So the shift in India has been towards more and more credit-based stimulus since then. First on the brick and mortar industries, then on the micro, small and medium enterprises, and increasingly now on the individual consumer, the household itself. In parallel, the government has expanded the welfare state very, very significantly. So the government borrowings have been on the rise. Nevertheless, the growth hasn't really picked up, partly because the government expenditures are mostly welfare subsidies. They add in the short run to growth, but they don't generate a fiscal multiplier in the long run, as say an infrastructure investment would. And so the Indians have been experiencing a decline or at least a stagnation in the real wages, as in many other parts of the world, or at least a slowdown compared to the 1990s and the early 2000s rate of wage growth. The household savings have been declining, and therefore the government balances, which are widening in the wake of falling gross domestic savings rate, mean that the fiscal dominance pressures in India are rising again. Even though India is now not a nationalized nation, it's a fairly decentralized nation, but still with some remnants in the form of the public sector banks, several nationalized sectors of the economy, and the attempts of the government seem to be more and more in the direction of skewing the terms of the financial sector to essentially support the public sector banks and the government financing programs. And so my sense is the fiscal dominance is rearing its ugly head again, because the benign initial conditions of the 90s after the 1990s reforms are now gradually disappearing and have been disappearing since the global financial crisis. I go on in the preface then to talk about what is needed on the fiscal and the financial stability fronts in order to reform India, so that the deep imprint of the fiscal dominance doesn't keep risking financial stability all over again. And I'm happy to get to some of this in the questions. But let me conclude these initial remarks by just noting that after the global financial crisis, Janet Yellen, who was on the board of governors of the Federal Reserve at that time, famously noted in January 2009 that a clear lesson of history is that a sine qua non for sustained economic recovery following a financial crisis is a thoroughgoing repair of the financial system. As I explained, in India, we've had a silent crisis since 2012-13. It's still ongoing. However, India has not done a thoroughgoing repair of the financial system. And therefore, there's an important message in Janet Yellen's quote for India, which is that the historical strategy of just shifting to yet another asset class to lever it up in the short term to position short-term growth numbers, even before the prior leverage boom has been cleaned up from its bust, this levering up strategy has repeatedly failed for India. It has derailed the economy's long-term growth plans because banks are no longer able to support growth because more than 50% of deposits are with undercapitalized public sector banks. And equally unsurprisingly, there is simply no asset class that is left anymore to lever up. And structural reforms are now critical in the real side of the economy, and institutional reforms are now critical on the fiscal and the financial side of the economy. As the pandemic stress in the form of COVID-19 outbreak has manifested, and dark clouds are gathering over Indian financial sector because of the likely, you know, increase in the losses that's going to get recognized over the next year or two. In my view, this is not the time to allow for another round of fiscal dominance, regulatory forbearance, and choking of credit as and when the economy is coming out of COVID. The right thing to do would be to actually fix the fiscal and the financial sector right now and use the time of the pandemic to repair the system so that when we are coming out of COVID, banks can be in a healthier shape to support an economic rebound. Thank you, Andrew. Let me stop here and take questions.
Great. Thank you very much, Viral, for that. Well, more than just an introductory lecture. I mean, it really does help to frame many of the key issues, not just in India, but around the world in central banking and financial stability. What I was hoping to do is to split our questions into three groups. First, I wanted to talk to you a bit about central bank independence, where you gave a very important speech. As you say, we took notice of it all the way halfway around the world, and I'd like to kind of continue that conversation. So I have some follow-ups for you on that. And then the questions that we've received from both over the weekend in advance and in the Q&A, I would split into two groups. One, the first group would be, say, historical things having to do with the things you discuss in your book. And then the second, there's a lot of people who are interested in your opinion of what's going on right now and how the central bank should react right now. So maybe we'll go into those three things. But I'll start with my prerogative. I've been waiting a long time to get a chance to talk to you about your central bank speech, which in many ways really it is not a normal, and I mean that in a good way. It was not a normal, hey, central banks need to be independent kind of speech. We get those all the time. That's been around in the literature for a long time. But it was actually making, I think, in some intellectual arguments that I had not seen made at this level before. So just as background, we have some students on this call here from Yale, and they're getting some of this in Professor Bill English's class. So maybe they've heard it before, but maybe perhaps everyone has not. I usually have heard in the past two arguments for central bank independence, and I believe you, and I added a third. The first one that we hear really has to do with technical competence. The idea being that the objectives of the elected authorities and the objectives of the central bank are the same, but we recognize that this is a technical thing, like science, and we don't think that we should be doing it. That elected officials should be coming in the morning and deciding what the target interest rate should be. And so we delegate that authority, but we recognize at any point in time that the experts might come back and tell us some things, and we as the elected officials can overrule them, right? And so the legitimacy still comes from the elected officials. The second argument, which you do hear, you do hear in other contexts, and you make rather forcefully, and is an important one, and that's where you use your cricket analogy, is the short-term, long-term way that things are set up, and that argument starts getting trickier for legitimacy purposes, but we understand why we make it. So the analogy in the West comes from the Greeks, and Ulysses tying himself to the mast. He's aware that he's going to go and hear the sirens, and so he decides in advance to tie himself to the mast so that the sirens cannot attract him to his death. So that is basically the elected officials recognizing the weakness that they have and making a conscious decision to delegate in a way that takes out of their short-term control what the central bank does. You've made an additional argument, which is a really strong one and interesting one, which is that there is unelected power, to use Sir Paul Tucker's term. There is unelected power all over the place in our society, and we see it in the judiciary, and we think it's a good thing. Elected officials appoint the judiciary, and then we do not expect the elected officials to interfere with that at all. And the fact the elected officials are elected and the judiciary is not, in many places, is not a reason to reject the judiciary. In fact, that is a good thing, not a bad thing. That argument about central banks, that's due, at least at the level that I've seen it. I'm sure my colleague Bill English will know more of the references on that. But for me, it was the most forceful time that I'd seen that. And so what I wanted to ask from this sort of long introduction is, do we have currently the political legitimacy to set something like that up? You can speak to India and the United States, where I think you have real special expertise, but anywhere in the world. And if we don't, what do we need to do to get there, to convince people? It does seem like people do understand the judiciary should be independent, that elected officials shouldn't be telling judges how to rule. But I don't think we're quite at the spot, but perhaps really we should be, that we think elected officials shouldn't be able to tell central bankers in extremis what they should be doing. So that's really the big question, and I don't want to take all our remaining time on it, but I'm just curious to hear. I know you've thought about this a lot, and if we have time, we'll come back to it later in some of our other conversations.
No, I think that's a great question, Andrew. I think you're spot on. I really started thinking about it, the issue more as one of sort of democratic design of institutions. And I really thought that the work of Esimoglu, Robinson, and Fukuyama, etc., had something to actually tell us about these issues. And I think in the end, sometimes we think of judiciary or, the commission that's governing the election outcomes, we just take their existence as given, that, oh, it must be that they have to be independent. How could they not be independent? But I think if you think a little bit more through the logic for that, it must be because we think that if we didn't grant them the independence in their operations and decisions, that terrible things will happen to the economy in the long run. To me, it is really a design issue, that we think that this is the right design, because otherwise it's going to be very costly. We'll have just crony capitalism of all sorts taking over the entire economy. There won't be a rule of law, and whatever economic historians have shown us on the importance of the rule of law for enforcement of contracts and growth on a sustainable basis, etc., would take hold. So I think it's a great question as to why we don't have this sort of acceptance for the independence of a central bank. And my sense is that we have not yet conveyed adequately to people at large the cost of financial crises. I think financial crises are actually happening all the time, all over the world. I used to say, even before the global financial crisis, that there had been 33, I remember it's in one of my papers, I wrote that there were 33 systemic crises in different countries from 1970s until, and this was written before the global financial crisis. And these are very costly. I think Reinhardt and Rogoff have done I think not just academics, but I think in a sense, the whole world, a huge service by documenting how costly these debt binges are. The fact that they create sustained output losses thereafter, that there seem to be in data, at least statistically, certain critical thresholds beyond which government debt to GDP levels seems to crowd out growth and so on. And I think in a way, partly the problem is the central bank itself, if I may say so. And this is what I was trying to get to a little bit, which is that why is it that silent crises are not fully appreciated by people? It's because the losses are not marked, and the banking regulator turns a willing blind eye, either because they themselves don't want to take on a crisis situation on their hands. They may be working with the government to take some short-term measures, hoping for a revival. So, whether it is justified or whether it is pure capture, The problem is that once you don't acknowledge the proper losses on a bank's balance sheet, you usually get into a series of band-aids, band-aid style solutions. And then over a period of time, once you have like 6, 7 years of this happening, it becomes hard for anyone to point to any one thing as actually being the cause of the current malaise. Because it becomes such a complex kitchen sink of problems by then, within once you allow it to fester for 6, 7 years. Uh, and so, in fact, therefore, it has gone a bit unnoticed, perhaps because of the title of my preface chapter being Fiscal Dominance. A lot of people think that I primarily wrote a chapter blaming the government or its short-term pressures. But if you read through the subtle text, the fact that the central bank gets dominated, and at times I'm explaining that the dominance isn't in the letter of the law. The dominance is actually more as an agreement or a backdoor compromise that the central bank strikes. That the central bank itself sometimes needs to recognize that safeguarding its operational autonomy, marking the books of the banks well, is actually a part of, in my view, remaining independent. And if you see my proposals, I'm recommending in most cases that the central banks do rule-based decision making with only rare exceptions. And when the rare exceptions are made, they have to be explained in detailed reports explaining the unintended and the intended consequences, and providing then a track record of whether my exceptions actually delivered or they didn't deliver. And to me, that would be the democratic accountability and legitimacy for being granted this kind of independence. Because then when you deviate from what is supposed to be your rule book, you are actually going about it in a manner that explains to people why I'm doing it. This is the standard I'm going to hold myself up to. And in fact, if these are supposed to be exceptions, there should be some sunset clauses on some of these. But you see the world over that, especially when it comes to not recognizing bank losses. This has happened in Europe, this has happened in Japan. And these were two of the prime examples that I kept using while pushing for stronger reforms to clean up bank losses in India. So to come back, I think there is unelected power. I think there is, in my mind, there is a scope for unelected power in the optimal institutional design of an economy for long-run growth. I think a central bank should have independence along the lines I was describing. But I think that independence should be kept democratically accountable through rule-based decision-making and explanation of deviation from these rules through reports and you know. But I think what happens is the central banks sometimes themselves want to enjoy the exceptions without having to explain it. And in my view, not only is that undesirable, in fact, I saw it on ground and I've seen it in other countries, that this is exactly the source of fiscal dominance. The fact that the central bank is willing to engage in discretion without openly acknowledging it is what actually creates the scope for fiscal dominance in the first place.
Thank you. That's very helpful, and to be continued. But I won't steal all of our time here. Let's move on to the second group of questions, which has to do with a lot of the topics from the book. Some of them do bleed into today, but we'll try to keep COVID out of it for this very first piece. And the first questions that I'm going to ask come from my colleague Bill English, who is for those people on the call who don't know, Bill was the Director of Monetary Affairs at the Federal Reserve Board in the United States from 2010 to 2015, and then a senior advisor to Chair Yellen after that. So he knows a few things about central banking, and he has a question specifically about questions about banking. And the first one is, if the government banks were mostly dealing with zombie firms, wouldn't that leave the profitable loans for private banks? Wouldn't they just step up? So that's part one of Bill's question.
Yeah, I think that's a terrific question. I've been writing about this specific point quite a bit in the Indian context. So the challenge is that private banks are stepping up. their market share has actually increased quite significantly over the last 10 years when public sector banks have been struggling. But the stronger implicit guarantee of the sovereign means that there is still greater trust in the deposits when they are with a public sector bank. So the migration of the deposit franchise from public sector banks to the private banks is happening because, public sector banks aren't generating enough profits even to service the deposits very well. They're not able to provide the depositor services like having adequate technology inside their branches, hiring the right human capital, digitizing the records of their depositors, and so on. But this happens at a glacial pace. It's also not that easy for private banks to generate capital without actually being able to get the deposit franchise to move over. So while the sort of steady and stable, effective backdoor reprivatization of the sector is happening as a whole, it's not happening fast enough. The second point is that because capital is scarce, the returns on capital are very, very high. And it has created a little bit of a situation where the private capital lending rates are not coming down as quickly as one would like because there isn't enough capital to compete for all the worthy borrowers of the economy. Let me stress here that India's credit to GDP ratio is only 55 to 56%. It's very, very low. And so it's to me, that's the paradox of India's credit system, that we have raked up massive bank loan losses without actually having the kind of credit to GDP ratio that China has, for example. And that's a signal that something is fundamental amiss. So what I've been proposing, therefore, on the reforms is that we need to find a graceful way of allowing the deposit franchise to move from public sector banks to private banks, and conversely, therefore, allow whatever surplus capital there is in the private banking system to get its hands onto the deposit franchise. And of course, that requires the government to shed its stakes, first below majority. The government has to become more arm's length from the functioning of public sector banks to allow them to have better governance. And third, that could then pave the way for a reprivatization. I stress here that these banks, most of them with one exception, were nationalized in late 60s and 70s. So India was not born with these banks as nationalized entities. They were nationalized. Most historical accounts agree that this was a political decision so that the government would have foot soldiers all over the country to deliver on its programs via the banks. And I think my main point is that after 50 years, there's not much to show in terms of that nationalization decision.
So thank you. A follow-up from Bill, and I think a quite important question is, in order to deal with the zombie firms in an acceptable way, don't you need a good bankruptcy process?
Yeah.
And does India have that?
Yes. So traditionally, India did not have that. So India put in place Insolvency and Bankruptcy Code in December 2016. It was supposed to have a time-bound resolution of this insolvency and bankruptcy cases. And well, a part of the subtext of everything that I said was that these cases were stayed by the judiciary. And there was a lot of disagreements with the government. What the Reserve Bank tried to do was to put in place a mechanism through which all the legacy assets which had aged as non-performing assets beyond a certain point, and using a size as a principle of proportionality for the economic importance of the case to the real sector, that these cases would start getting submitted to the bankruptcy code by the banks. What happened is that certain sectors, my sense is the electoral pressures were exploited by certain sectors to make the case that they are an important sector. I'm referring to the power sector notably, that they are an important sector, that these assets can't really be dealt with by a bankruptcy code. They have to have an out-of-court restructuring, etc. And regardless of whether that argument was right or not, at the time it was made in 2018, I just used the evidence of the last 2 years to basically, I've gathered the evidence. Nothing of any significant restructuring has happened in that sector in the last 2.5 years, in spite of them being given now, this window of stay and many of these cases not being referred to bankruptcy. So I think to answer your question more directly, I think there is a bankruptcy code. Uh, Post-COVID, the bankruptcy code is not accepting any new cases, at least for a year, I understand, certainly for 6 months, maybe even a year. But I think the point is that the filing of the case from a bank to the bankruptcy code is also a decision that the bank has to take. Now, banks, if they are public sector banks, come under pressure not to file certain cases because that decision can get influenced by the government machinery. The Reserve Bank of India, in order to ensure that there was no such discretion to the banks, required that at least the aged non-performing assets above a certain size be required to be finally put into the bankruptcy code. And that is where the biggest one of the biggest disagreements with the government came about. Ultimately, for whatever reason, that circular that the Reserve Bank of India gave to banks to file these cases, it was struck down by the judiciary, and now a slightly more diluted version of it is in place. But the fact is that that process has certainly slowed down the recovery of the cases. So I think I'm giving you a long story, but I think to make it simple, Bill, the point is that banks still have to file these cases into bankruptcy. And the problem with provisioning being so backloaded is that, see, in US, what happens is that the provisioning is mostly done by the time a default takes place. So a bank actually wants to recover on the provisions because it has already provided for the losses. It wants a write back of the provisions for whatever recoveries it gets. In India, most of the provisioning happens in a backloaded manner. And so banks are always doing the calculation. If I don't file this case, I'll get to postpone my provisioning by such and such standard. So that's one problem. And the second problem is that because public sector banks are so large on the non-performing assets, there can always be government influence in the decision to file these cases into bankruptcy. And the question then is the central bank allowed rights over the public sector banks in order to require the filing of these cases the way it would have these powers in case of the private banks?
Thank you. We've talked a lot today already about banking, and but in your book, you're quite clear when you have your manifesto right at the beginning. It's about banking, but it's also about developing financial markets so that the system is more diverse in its providing of finance for the Indian economy. We have a specific question from Saket Kumar, who asks, you made pointers to hit the ground running on improving the health of the banks. What would be your pointers for further development of financial markets in India?
So, I have a very detailed speech on this. I recommend it very highly. It turns out that these problems of fiscal dominance and development of markets are actually quite tied together. So let me make two most important points here. First is that the government of India is such a large borrower now that it dissaves more than the savings of the rest of the economy. So on the margin, it has to borrow from the rest of the world. And the corporate sector, which is also a net dissaver, also has to borrow on the margin from the rest of the world. Now, of course, because of, the type of institutions, the fact that India is always running a fiscal and a current account deficit, sudden stops are very likely in case of India when, the global financial sector is not doing as well, or, there's a surprise shock to the US rates, or the Fed is normalizing its dollar liquidity position in a significant way. So there are limits. In any case, smaller borrowers can't go and borrow in the external capital markets. So first and foremost, I think the government has to leave some space for others. If the government is running a deficit of 10% to GDP as it was pre-COVID, and it will go to 15% debt to GDP post-COVID, there's not much space for anyone else in the Indian markets to borrow. So that, to me, the Indian corporate bond market is a non-starter for all practical purposes, because there's just not enough savings left on the table for anyone else to compete with. So then you get only the very, very highest rated companies whose paper can act as a substitute for the government paper being able to borrow in the market at reasonable rates. Everyone else has to pay an extra quantity premium being imposed by the size of government debt for them to borrow. They're just getting crowded out in a very traditional quantity sense. The second point is that because the public sector banks are present and the Life Insurance Corporation of India. So the insurance sector in India is also very heavily controlled by the government. The pension funds are mostly also government run. The terms of engagement with these entities with the markets are all skewed to favor the government bond borrowing programs. So the Life Insurance Corporation of India, the pension funds, India, the EPFO as it's called, they invest far more in government bonds than typical insurance companies and a pension fund would. You would think these are sort of really long-term investors who would not just go for treasuries, they would also go for long-term corporate paper, equities, maybe other types of investments. But those quantities are actually very, very small parts of their portfolio as of now. And the third and last point I would make is that there is a fiscal dominance of the market regulations in India. This was a point I didn't touch upon, but it was something that I fought actually quite hard against with some success. Is that what happens in India is that when public sector banks are asked to buy government bonds, they never actually recognize the interest rate risk of these securities. So if interest rates rise and the government bonds have to be marked down on the bank's books, just the way bank losses due to defaults in credit side are not marked on time, treasury losses of banks are also not marked on time. Now you can see what the chain of events here is. Because if banks had to mark the interest rate risk of their losses when they materialized, they would actually require a premium on that more frequently in the government bond borrowing programs. Let's say, suppose the RBI was able to push through a marking to market of these losses in a timely manner, then the pressure would turn to the monetary authority to not raise interest rates in the first place. So that there isn't this marking to market on the bank books. And so even though some people who have read my preface chapter find it almost incredible that there would be pressure on the interest rate authority to not raise rates because it would cause a mark to market loss on the public sector bank balance sheets, I witnessed such pressures during my times, and therefore I'm actually writing about them very explicitly. So my sense is the fiscal dominance pressures in India are so pervasive that every single policy that a central bank is attempting to do, there is a pressure point, there's a compromise point on that policy. And it all comes through the fact that it ties into the banks, it ties into the government borrowing, it ties into the cost of government borrowing. So ultimately, we just have to break this unholy nexus. I think if banks got mark-to-market losses, they would actually have to manage the interest rate risk, and there would be a chance for the interest rate market to flourish. Right now, they've gone into this chicken and egg argument that they keep giving all the time, is that, oh, there are no interest rate derivatives markets. But yeah, it's because you have never really gone out and sought to manage your interest rate risk in the first place. And so what happens is, instead of managing their interest rate risk, they, in their frequent meetings with the government, start lobbying to tell the RBI to not recognize the losses, because if you don't recognize the losses, then the government doesn't have to inject capital into banks against these positions. In fact, conversely, interest rate cuts are often liked in India because they would transfer treasury gains to the banks in order to make up for the losses that they have made on the credit portfolio. And so this is another channel through which the central bank's interest rate setting gets distracted away from its price stability objectives and starts co-mingling with the fact that you want the public sector bank balance sheets to not look too bad. It's very deep and it's very perverse. I think it just shows that once you have government meddling so deeply into the financial sector, it's hard for the central bank not to have tools which don't become sort of pressure points on a daily conversation.
Great, thank you. Let's move to some real current stuff related to perhaps you've heard that there is a pandemic in the world. I don't know if that's reached if that's reached New York yet, and you've seen it. But we're having a rough time globally, and I know that it's recently gotten quite rough in India. So we have a question that came from Dr. Ajit Kumar over the weekend in advance of your talk, just pointing out something important which I didn't realize, which is that the political class, this part we knew about, has all along been accused of fiscal profligacy, but now many economists are accusing them of excessive fiscal prudence. And he was interested in your comment in the context the pandemic is not over yet and much more support might be required in times to come. What's the right message for economists, policymakers to be given to the fiscal side now in India?
Yeah, I think it's a very important observation, and I think it's spot on. And I think it shows the cost of the short-run government expenditure focus, which is that, so one analogy I didn't use from the preface chapter, but I described that the fiscal and the financial stability situation in India are like rubber bands. They are always stretched so tight that even a small shock will cause them to snap. And that sort of little bit of fear has crept into the perhaps the finance ministry, the bureaucracy as a whole, that if they undertake the necessary relief and repair expenditures for COVID, that India is going to get downgraded. India's rating, sovereign rating, is right at the cusp of investment grade and junk. It's right on the border. And the concern they have is that such a downgrade could actually have sort of knock-on effects, especially on the external sector, etc. There could also be perception issues that the governments may be concerned about, that their fiscal profligacy of the past has caused this downgrade and so on. It would not make for popular headlines and so on. But the repair and relief efforts are needed. Unfortunately, India's infection curve has not even peaked yet. It is just on a, still looks to be growing at, close to now 90 to 100,000 cases a day. The worse, the pandemic is now spreading gradually into the rural areas, and the farming was sort of agriculture was one of the robust sectors over the last 2 quarters compared to the slowdown that has been observed in the urban areas. So what is the way out? I think it's a great question. And actually, in the coincidentally, even though my chapter was written pre-COVID, I think the book actually offers what I think is a reasonable solution, which I'm trying hard to get it attention through op-eds and so on. But in my view, what India needs to do is that India's main problem is that it has lost credibility of its fiscal targets. So there is something called a Fiscal Responsibility and Budget Management Act. It was passed in 2003 and then revised in 2016. It sets targets for the government on its debt to GDP and fiscal to GDP numbers over the medium term. There's an escape clause there in case of a situation such as COVID that you can deviate, but India was way beyond the escape clause deviations, even in the pre-COVID era. And in India, partly these deviations have happened because the governments have resorted to all sorts of off-balance sheet shenanigans to hide the true government borrowing. So if you calculate India's public sector borrowing requirement, So how much is the center borrowing as a whole, the states borrowing as a whole, and inclusive of their public sector enterprises, because a lot of the borrowing happens through entities which are for all practical purposes backed by the government. Take the, say, the Power Finance Corporation of India, which is basically a bad bank that's rolling over all the bad loans in the power sector. But that's effectively a government borrowing. If you calculated this public sector borrowing requirement, the government has been violating the fiscal deficit norms by as much as 4 to 5% of GDP, even in a pre-COVID era. So the government has lost credibility of being able to stick to its pronouncements on the fiscal front. So, in my view, what the government should do is to undertake a decisive fiscal institutional reform package, commit to it now for over the medium term, and actually go ahead and borrow what it needs to borrow in the short run, because the relief and the repair expenditures are required for the citizens, the real sector, and the states which are the most affected by COVID. What would these reforms be? In my opinion, they would at least have three important components. First, it's not enough to have the targets. There's a Goodhart's law, which is that if you set a target but then it can be manipulated, then your achieving of the target is going to have no economic meaning, because you will attain it just by manipulation. And that's exactly what has happened in India. What India needs is to reduce the manipulation of the government's fiscal deficit numbers. So it needs something like the Congressional Budget Office of the United States. It needs an independent, non-partisan or a bipartisan council that will vet every single program of the government and then say this is going to be the budgetary expenditure that's going to be required to undertake these programs. Right now, what happens is these programs get announced. Every time the budget is announced, it looks to match up with the deficit targets, because the government just goes and makes extraordinary growth assumptions every single year. And then they are always never met. And that discussion as to whether these budgetary numbers are right or not has to happen before the budget is announced and when the programs are structured. And right now that doesn't happen. So I think India needs a equivalent of an independent fiscal council. Second, India needs to calculate and report at least once a year, if not twice a year, this public sector borrowing requirement, because there are so many public sector enterprises in India that you don't get a true economic sense of government borrowing if you don't actually account for their liabilities as a whole. This can be done by the Comptroller and Auditor General of India. Their office gets all this information. They can either put out the information for others to calculate these statistics, or they can put it out themselves. And third, India has to just rely on less borrowing. India needs to undertake a massive divestment program. There are lots of sectors in India where the government has no business to be in. We just discussed in response to Bill English's question that there's undercapitalization, and yet implicitly through the backdoor guarantee, the deposits are safer in the public sector banks. That has to change. And how do you do it? The government needs to divest its stakes below 50%, reprivatize many of these entities, both for a financial reason as well as for an economic reason, so that these entities are actually allowed to run more efficiently. So in my opinion, two fiscal institutional reforms, a fiscal independent council, and a transparent public sector borrowing requirement calculation. And third, a wave of divestment program that basically allow the government to reduce its borrowings would be what is required in order to borrow in the short run. If the government does these three things, in my view, it will be providing medium-term commitment, and then it needs to go about and spend more money on infrastructure and growth rather than on continuous distribution of welfare subsidies, which don't expand the pie in the long run. So it needs a package. Just going and borrowing is not going to work. Doing nothing is also not going to work. You need an interim path where you do what is needed in the short run, but you restore your credibility in the medium term. I think that is what India needs, in my view.
Thank you. So we have a question from Sushil Reina, and let me give a little let me give some context, some US context to this, because I think it's really a great question. We've touched on a lot of the issues so far today, but I think it's quite a global question in the age of COVID, which is in the United States right now, what we're seeing is a lot of, well, rules that are in place already, plus additional pressure to allow people to have moratoria on paying for their rent, or moratoria on paying leases or mortgages, things like that, which ultimately are kind of unfunded mandates on the banks. In the United States, that manifests itself in a complicated, in the short run, these are not state-owned banks, so we're kind of pushing a bunch of this on the private sector. In the long run, the government owns the tail risk, and the political, the political crows may come home to roost all at once. In India, of course, because of fiscal dominance, this is all happening at one time. What Sushil Reina asks is, majority of these banks are facing asset quality issues. As a supervisor, though, recognizing, you are part of the government, should you be pushing for more lending now, knowing the impairments will increase? But effectively, this is kind of part of stimulus and part of what the government should be doing. So how do you balance the concern about financial stability with the pretty desperate times that we're in right now?
See, I've tried to keep my thinking on this relatively simple, which is that my sense is that if ultimately the package is a government package, it is a fiscal action and the fiscal authority should pay for it. I think that's my sort of long and short of it. Now I can get into subtleties of this, which is that, what does that mean? Either it has to directly make transfers to the real sector in order to help them to make payments, or if it wants to give them debt moratoria, then the loss is going to be borne by the banks, and then it has to recapitalize the public sector banks. And if the moratoria are forced on private sector banks, in a way, even the private sector banks have to be paid for the fact that this is a quasi-fiscal action in the end. So as far as the financial sector is concerned, in my view, it all comes down to the single question of capital. To sort of just give the standard analogy, when you make an investment, it's in a real estate, it's all about location. I find that in the end, whether the financial sector does right things or not, it all boils down to whether they have adequate capital in their balance sheets or not. Because when they have adequate capital, they tend to lend well and in the right places. They have skin in the game. They worry about losing this capital to losses. But when they don't, they either do zombie lending or they do lazy lending to the government, as we were discussing earlier. So I think the out-of-court restructurings, maybe to an extent, the moratoria, etc., makes sense. But until you do the economic calculation of how much capital you are going to have to pony up to put into the banking sector at the end of the day, you cannot actually figure out what the true costs of these packages are. Like how much moratoria should one give to the real sector? It ultimately also depends on whether you can leave your banking sector well capitalized at the end of the moratoria or not. So I think if one goes about it in this simple manner, which is that it's a fiscal decision, ultimately the cost is borne either by the borrower or by the lender. There's a hole because of the COVID shock that has to be filled in. And how much of a hole you're going to have to fill to ensure that the banks remain economically viable in the sense of making the right lending decisions when you come out of COVID. I think these calculations can be done. What has happened is that the moratoria decisions have been made, but there is no pressure on the banks to raise capital to meet the standards. And I think that's the problem, because until you do these two calculations together, you don't know how much moratoria the system can afford as a whole.
It's very interesting because this is a situation where, in fact, having state-owned banks provides a little bit of a political advantage, since you can, the things like moratoria are very popular, and they also really seem, they seem to be progressive and merciful, but in the absence of having a state-owned banking sector, to recapitalize the banks often requires an overt political act that is deeply unpopular. And
Yeah,
so,
in fact, I think, Andrew, you're absolutely right. If you think about the mortgage modification programs in the United States, they could only be delivered because Fannie Mae and Freddie Mac were owning most big chunk of these mortgages. And I think that could be an advantage. I think that the trouble is that, the fiscal that is backing the Indian banks is not as strong as the fiscal that is backing Fannie Mae and Freddie Mac. And that this goes back to the question that was asked earlier, that India is right now not even undertaking the kind of fiscal expenditure most people think it should be undertaking in the midst of the pandemic. And I think that's a reflection that they are not sure about the fiscal capacity at the present point of time.
well, Varel, this was really terrific. I think we are at the end of our time, and really delighted that you could join us today. I encourage everybody. We sent around a link to where you can go and buy the book. I had a fun time this weekend. I was pleased that some of these speeches I had already seen before. I had a fun time this weekend seeing how you pulled things together, and I encourage everybody to go out and buy it and share it and read it. So thank you very much.
Thank you, Andrew. It's been great to chat about the book. And I think as I was sending the message home, let me just reiterate, my sense is that it's hard to understand anything in India, especially in the financial sector, without getting your head around the fiscal side of things. I think that's one message I would like to convey from today. And I hope you enjoy reading the book, and all the best to you and your loved ones in these challenging times.
Thank you. You too, and all the best to all of our participants today. Thank you.